Is inflation stickier than anyone wants to admit? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Brent Donnelly, president of Spectra Markets. Hi, Brent. It's great
Hey,
to have you
Maggie.
back on. Happy Friday the 13th.
Yeah, it's triskaidekaphobia time for some people.
Very
What's
impressed you
interesting?
know that.
I was just coincidentally yesterday. Someone was saying to me like, the whole like, oh, it's unsustainable that VIX is this low or whatever. Sometimes people say that, and so did a histogram of all the VIX closes since 1990, and 13 is the most common handle for VIX to close on
All
9% of
right.
the time. There you go.
That's spooky. That's a little spooky. There is something to this. Um, yeah, listen, a lot of people are wondering why VIX is so low. But and today certainly stocks marching in place. But it did seem like bond investors are getting a little nervous about inflation again. We saw a pretty big move in Treasury yields. What are you watching there?
Yeah, it's interesting this week because you had a few times where they tried to take bonds higher, one auction and then a couple of data points, and then even payrolls actually they tried to take bonds higher. And every time it was like the yields were like a beach ball underwater where it's just like, they're trying, and they just keeps on getting rejected. And I think there's a couple of reasons. The one to me is that inflation isn't going down anymore. I mean, it hasn't been going down for 6 months. And so like people say like shelter's getting better and all that, but like shelter's not even a real number, right? Like it's a 1 year lagging number that isn't really actually real. It's like, OER and all that blah blah blah. But if you look at core services and wages and even core PCE and core CPI, none of them are even close to target, and none of them are going down anymore. And so, like, forget about not price levels. Obviously, we don't want price levels to go down. But if the Fed wants inflation at 2 and they have no idea, I mean, you can argue whether they actually care if inflation goes to 2, but if they want inflation at least going down or not going up when it's way above 2, then maybe this is the last cut for a while. And I don't know. I think I'm starting to get interested in bets on no change for 2025 because there's a lot of times when the Fed stays on hold for prolonged periods. And I don't know if you want to talk about neutral and all that, but since they don't know where neutral is, why not?
Yeah, yeah. By neutral you mean for folks who may not be always thinking about sort of these economic points that the Fed goes over, but the neutral, the rate that they can keep it at, where they kind of have it Goldilocks, right? Not too hot, not too cold. Inflation, they're restrictive enough that you're not going to see inflation. Where do you think neutral is, and why is that important?
Well, yeah. So the theory, I guess, is that if interest rates are at neutral, that you'll neither be restrictive or accommodative, and that's neutral for financial conditions and neutral for the economy. But the problem is like they don't know where that is. Like nobody knows. So what they end up doing is they hike for a while. They probably hike more than they need to just to be certain because they want to make sure they're above neutral. And then once things are under control, then they want to, glide the plane back down to neutral. But the problem is the longer that rates stay up and things don't break, then the higher you have to estimate that neutral is because, if Fed funds has been on a 4 handle or briefly on a 5 handle for this long and everything's super fine, then it gets harder to argue that neutral is 2.5. So the Fed has been raising their estimate of neutral, but it's very slow. Like basically, it ends up being very pro-cyclical and very unobservable. So, it's kind of this finger in the air thing, but the way that it tends to work though is like Bowman from the Fed was saying this week that she thinks that neutral is probably higher. And the reason is that nothing's breaking, right? So like the old thing going into this cycle was the Fed's going to hike until something breaks. And there's always the memes of like the duck or the goose or whatever, like going, tell us what's going to break. Tell us what's going to break. Do you know that meme?
No, I don't. No,
Okay, some people will know it, some won't.
everyone else will. I've
But
been
it's basically like, okay, they're gonna hike till something breaks, but nothing. We keep looking around, and like Silvergate, I guess, broke, but like generally nothing's really breaking. Commercial real estate kind of broke, I guess you could say too. But overall, the financial conditions are still very loose, and nothing's breaking. So then, sort of like by proxy, then you assume, okay, I guess neutral. is higher than we thought. And I mean, without getting too boring with the with the economics and all that, but I think this is an important point. The thing with neutral is that it depends a lot on the structure of liabilities in the economy. So just imagine a world where everyone's fixed at 0 and the government is the only debtor in the world in the economy. Even if the Fed hikes to 10%, the government's just gonna pay the interest, and that's not gonna impact the economy at all. If anything, it would be stimulative because some of that interest will go to pensioners and savers. So in the US, you have like a less extreme version of that. You have a lot of people fixed with their more fixed liabilities with mortgages, and higher rates actually kind of benefit some people. And then eventually, as the debt rolls, the liabilities roll at higher rates, and then that's bad for the economy. But in a country like Canada, where a lot more of the liabilities are variable,
Mm.
then you potentially could see a lot more damage faster. So again, this neutral thing, like it's so complicated and it depends, but to me, it depends a lot on the structure of the liabilities because when you rip rates higher, the intention is to suck some of the money out of the economy and make it, more
Yeah, inflict
difficult.
some pain.
Yeah, and there's no pain if everyone's fixed at, fixed mortgages.
I think that is such an important point, and I think it's one that people have r talked about more and wrapped their head about more as we've seen this hiking cycle, right? In the beginning, everyone's like, "What's going on?" But now everyone's kind of, like, looked under the cover. Where do we get it wrong? Why has this not happened? I saw an
And
interesting stat. I think that people are we're starting to get to that point, though, where more and more people have mortgages at a much higher rate. I don't know
that's
where we
true.
are in that. I thought people said we're almost at the point where more mortgages are at 6 or 7 than they are at 3. I don't know if
Mm,
that's right. I don't know where I saw it, and I don't know how reliable it is, but at some point, that would be different.
yeah, that's not quite true, but if you look at the lines of, like, who's fixed at 3 and who's fixed at 6, it's basically going like this. So, like, they will cross, but they haven't crossed yet.
Yeah.
So yes, I mean, I think that's the thing that's funny is that by the time everyone agrees that neutral is higher, then the long and variable legs kick in and the shit hits the fan. So
And the pain
it
comes but the timing is off. So,
yeah.
Chris, hi, everybody in the chat. Happy Friday to you too. We made it. Chris had asked even before the show started, and I think we just answered your question, Chris. Please ask Brett if it matters if CPI bottoms at 2.5 instead of 2%. The 2% target was invented and deemed acceptable. I think we just answered that with this question, Chris, but put another one in there if you want a little bit more meat on the bones. So, by the way, we did a poll, and I think there are a lot of people that are is the Fed gonna cut in 2025? And like 82% of you right now say yes. So if they don't cut, Brent, that's not priced in the market, is it?
So just to Chris's question, I'll just super quick just elaborate a tiny bit more. I mean, the short answer is no. I don't think it matters whether inflation's 2.5 or 2. I don't think they care at all. In fact, if it was running steady and flat at 2.7, I think they'd be perfectly happy with that as well. The problem is that if it's rising, I think it's the rate of change that matters more at this point. So to Chris's point, yeah, 2 is completely arbitrary, and I don't think it's really that important. But if it goes from 2.6 to 2.8 to 3.1, then we've got a problem. And in terms of the Fed, yeah, it's interesting that the there aren't a lot of people that expect Fed on hold. I think we're in kind of this like after all this manic, movement. So COVID, the massive cuts, then nothing for a bit, then massive hikes, then some cuts. You kind of feel like the Fed's just always doing stuff, but historically they're not always doing stuff. So there's periods from whatever 20 I don't know, 2010 to 2016, I guess. They didn't Fed funds didn't change. I don't know, I might have it slightly off, but there was around 4 or 5 years there. In 1995, after they cut a couple times, they were on hold for all of 96. So it's not unusual for the Fed to just sit there for a year and try to figure out where they are. So I think that's one reason it's I almost hesitate to say that I think stocks are gonna go down in Q1 just because it's one of those times where it feels stupid to say anything bearish about stocks, but I do believe that Q1 is gonna be tough for stocks because 'cause you're priced for perfection, and I don't really think you have the Fed at your back necessarily. Like, I don't think they're gonna hike, and I don't think they'll be pricing for hikes. but I don't think that they're gonna cut either for a while. I think this December cut will be like, "Okay, we're doing this, and now we're gonna wait and see," and we're in absolute wait and see mode, and, we're a little bit worried about inflation because a lot of the Fed people from the Fed, like Musalem and Bowman and a couple of others have said, "It's not really mission accomplished here." And, there's that kind of ridiculous chart from the '70s that always goes around, that shows, like, inflation came down and then it went all the way back up, and,
Mhm.
there was an oil crisis in there that might have had something to do with it. But still, Powell I mean, everyone understands, like, the election was probably decided by inflation. You don't as Powell, and also they made an embarrassing mistake in 2021 and 2022.
Mm.
So, like, every politician and central banker in the world is still scared of inflation. I mean, shit, that was only 2 years ago. So, I think now they're gonna be much more conservative as they are now somewhere down within maybe 100 points of neutral, I guess.
Yeah,
And
what's really interesting? Just on that point, I thought it was interesting that Donald Trump came out in an interview. I think it was with Time Magazine. He was named Person of the Year, and said that, yeah, it's going to be hard getting those prices down. Once things go up, they don't go down. I mean, we're going to try, we're going to do our best, but starting to moderate a little bit those campaign promises, like absolutely, grocery store prices are going to, head lower once I get elected. So I think that you're right. I think there's a lot of sort of respect toward inflation and the fact that it was such a hot issue for voters.
yeah, and I think that tempers the deficit, spending stuff a little bit too. That's why, like, bonds rallied when Besant came in because unlimited, like, MMT style deficits are gonna rekindle inflation, and so what they wanna do is, like, reduce taxes for the rich and, spend as much money as possible without stoking inflation. So they're going to try to optimize for those things, I think. But they're primarily going to be optimizing for like don't push inflation back to 5% because that's not good for the Republican for the dynasty that they're trying to build, I guess, for the next few cycles.
Yeah, well, it's tricky given some of the other policy measures. I want to ask you about something. So you've been talking about something in your AMFX newsletter, which
Mhm.
I always read and love and take away so much for. So thank you for that. But you said something that all the leverage in the system is in financial markets, not the economy. Why is that significant? Why are you flagging that?
So generally, like that, going back to what we were saying, like they hike until something breaks. Usually, once it's the Buffett thing of when the tide goes out, you see who's swimming naked. And so, normally, when rates get raised, then that puts pressure on anyone that's leveraged, right? So, like if you have three homes and two of them are, you lied about the down payment and scraped by to make, a minimum payment every month, and then your rate goes up, then you start people start getting foreclosed on.
Right.
And
Consumers have too much credit card debt, they're overextended. That's usually what we see
right.
play out.
But the thing is consumer balance sheets and business balance sheets are just so rock solid in the US that there's really not a scenario where, like, you get some kind of huge deleveraging of the US consumer because the US consumer delevered in 2008 and then got given, like, $3 trillion in cash in 2000 in 2020, and, like, that money has slowly been spent, but a lot of that money was spent on, when it went to savings, went to debt repayment and all that. So then you say, okay, well, how can you get a big sell off in the stock market at any point if there's no leverage in the economy and then you're not really vulnerable to recession? And normally it's recessions that trigger the really big bear markets. And so I don't
Hmm.
think we're in a position to enter a bear market, but why I think we could get a big correction in Q1 is that first of all, things like if you look at any sentiment or positioning measure, every single thing is pinned to like redlined to the max. Like consumer confidence, the conference board survey of like, do you think stocks are going to go up or down next year? That survey's been going since 1987 and it's the most bullish it's ever been. That's just one example, but there's like 25 of those. So towards the end of the year, people don't like selling winners because of the tax implications. So in January, I think there's kind of going to be a reappraisal of like, okay, we're priced for perfection. The Fed doesn't have our back anymore. But then and a couple of other things like the potential risk of big tariffs if they actually happen on supply chains and inflation and the economy and all that. But then to answer your question, I do think despite the fact that there's not much leverage in the economy, I think there's a lot of leverage in the stock market. Like there's one thing you can do, which is you look at all the double and triple levered ETFs, and there's longs and shorts, right? And people can do either. And the longs, like if you look at a chart of the ratio of longs versus shorts, it's like and whoops, like that. So people are doing the triple longs. They're doing MSTU, MSTX to get extra leverage on MicroStrategy, which is a leverage play on Bitcoin, which is a leveraged crypto instrument that people trade 20 to 1 on leveraged platforms. You know what I mean? So
Yeah.
I think there's a lot of financial leverage in the market, even though there's not much leverage in the economy. So again, like does that mean it's the end of the world? No, it just means that I think the risk reward of stocks in the first like 12 weeks or even first 8 weeks of the year is going to be super bad.
I think that's a great explanation because it kind of takes the recession out because kind of people say, well, there's a, this economy's going gangbusters. It's US exceptionalism and all these reasons that can fuel even the AI, which a lot of people admit is real.
Mhm.
Maybe it's a little frothy in some spots, but there is definitely something going on. So those are the arguments you hear against a downturn, but you put it a very different way and focused on a different part of it that I think is super interesting.
Yeah,
Christopher
it's more
said,
like endogenous versus exogenous. Like usually
yeah.
there's the economic impact, which is exogenous, but sometimes there's just corrections in the market for reasons that are market related, right? Like, I mean, not to say that things are going to crash like the flash crash, but like there's events like the flash crash in May of 2010 that are they just happen because they happen in markets and nothing's going on in the real world necessarily. And I mean, if you want something from the real world to be the catalyst, you can have maybe larger than expected tariffs, or you can just have like a run of weak data because of seasonality, or like people are front loading ahead of tariffs, so you get really shitty data January, February because people are front loading now. I mean, there's plenty of random things, but I think the point is more that when you're priced very optimistically and everyone's bullish and there's a lot of leverage, then after the fact you can point to some random catalyst, but before ex ante it's sort of like who cares what the catalyst is.
Yeah, I like to say, "What could possibly go wrong?" When that's it. Let's ask ourselves. That's what I've been asking myself. So, we've got a lot of great questions coming in. Let me try to get to some of them. So, by the way, Christopher agrees that stocks down first quarter is a layup. Not afraid to say so. Bravo,
Uh-oh,
Brent. Thank you. Christopher
nothing's
has
a
a question.
layup. No, don't say that.
No, don't jinx us. I'll get to your question, Christopher, about bonds in a minute, but first I wanna do J&J. Does Brent think any of Trump's policies will affect Fed policy markets, and if so, which ones? Um,
So
Tariffs being the obvious suspect, I think.
yeah, I think tariffs is actually too difficult to game plan for the Fed because it's a one-time inflation shock. It's not like a persistent inflation shock. It's bad for supply chains. It's potentially bad for trade. It's potentially bad for the economy. So, like, there's so many different lenses you can look through. Like Smoot-Hawley was not inflationary at all because it destroyed the economy. So, or the economy got destroyed by various things at that time. So, for example, and then in 2018, the tariffs were targeted enough and were kind of rolled in or scaled in enough that, I mean, if you look at a chart of inflation, you can't even see it. In
Mm,
fact, actually, inflation went down after the tariffs happened, but it's just pure coincidence. So, in terms of tariffs, I don't think there's really a Fed story. In terms of fiscal spending, I think that's where like if there's some kind of big fiscal spending that ends up happening, which doesn't really seem to be on the in the plans, that's the one thing that the Fed would have to react to because there's the kindling is already there for inflation to go back to 4.5%. So if there was fiscal spending, I think so. I mean, the other one would be like, and I'm like the biggest skeptic on the government restructuring stuff, like adding consultants on top of a huge bureaucracy, like adding two co-heads who are consultants on top of a massive bureaucracy when you already have the GAO trying to do the same thing. Like everyone wants a more efficient government, but actually doing it is so difficult because the consultants who have been hired don't have a mandate to do anything other than make recommendations, and then those recommendations need to be implemented by this bureaucracy. So I'm very skeptical that they'll be able to cut government jobs or cut government spending. I mean, they're talking about 1 trillion of cuts, and discretionary spending is 1.7 trillion. So that's 65% of all discretionary spending. Like, it's just not, I don't think they're serious. And I think the memes that are being posted by Elon Musk show that he's not very serious. It's just like what they call kayfabe in the wrestling business, where you just, have a big story. And so I'm not a big believer in that. So, and then tax cuts will be more marginal than last time because they're coming from a lower level. So overall, I would say the policy mix isn't really a big driver of Fed policy, except for if somehow spending gets unleashed, then
Mhm.
that would definitely be a factor for the Fed.
Christopher's asking, please ask Brent, does he follow the MOVE index for bonds? And if so, what does he make of the recent activity?
Yeah, I do. Actually, it's interesting because the VIX obviously is at the lows. Move came off a lot, but CVIX, which is the currency equivalent 1 month currency vol, is not pulling back nearly as much. But I think it actually makes sense because, like, related to the prior question, when you ask, okay, what markets are these policies going to impact, and you sort of look at the suite of what Trump's going to try to do, and like, deporting immigrants, illegal immigrants is basically impossible. It's not logistically feasible to, other than grab some criminals or whatever. They're not deporting millions of people. Like, that's going to be literally impossible. And then the government expenditure cutback, or the efficiency stuff, to me is not really doable either. So tariffs is the thing that's doable. So then you go through the capital markets and say, okay, what does that affect? Well, inflation kind of, but it's a little bit not totally knowable. Stocks may be bad, but is it? I don't know. It's probably good for some companies and bad for some companies. But for the dollar, it's just unambiguous. Like, if they do tariffs, the dollar will go up. And we saw that in 17, 18. Like, he promised tariffs and the dollar went up, and then he didn't do it in 17 because he was trying to negotiate. Trump was trying to negotiate with China for a while. So then the dollar went straight down. And then the second that the tariffs happened, the dollar ripped again. And it's almost like, almost, but not quite, a mechanical thing. So to me, it kind of makes sense that move and equity vol would be near the lows because there's no policy shock coming. But for the dollar, there is a policy shock coming because whether he does the tariffs or not, at this point, it's enough priced in that, like, say Trump just said, like, just kidding about the tariffs. I mean, the dollar will drop 5% in a really short time. So, and if he does a 60% tariff on China, the dollar will go up 5%. So we're in this weird, kind of like this binary disequilibrium in the dollar. Like, either it's got to be 4% higher or 4% lower, but it's hard to imagine it would be here unless there's some, like, thread the needle thing where he says, we're going to do a small tariff now and we're going to increase it by 1% every 3 months. So, or, something that's like really in between. But otherwise, to me, it kind of makes sense that vol's relatively low, except for in FX, where even though vol's higher, I think it's actually still too low in FX because you're going to have something on January 20th, or in the weeks very right after that, related to tariffs, and then we'll have a lot more information for the dollar.
Yeah, and that, the slow gradual doesn't seem like if Trump has his way, that'll be what happens, given that he invited Xi Jinping to his inauguration, as well as every other world leader, like, totally unprecedented. Rang the bell of the stock exchange, a place where no president wants to go because they'll loop it if anything happens. Like, he doesn't care. He's
Yeah.
just paving his own way. But if Besant has his way, maybe you see something more gradual. Doug asking, I don't think you sound like you're not sure, but where do you think the DXY heads? Doug wants to know.
So I think it goes higher, but simply because I think the tariffs are coming. So if say, like, dollar Canada is the best example, because, like, if Trump were to do 25% tariff on Canada, I mean, that's the end of the Canadian economy. Like, in the GFC, Canada lost like 500,000, 600,000 jobs. And the estimates are like 1.5 million jobs will be lost if Trump did a 25% tariff on Canada. So that's like dollar Canada, 7% higher. I don't think he'll do it on day one, like you said. I think Besant and actually Musk has spoken too about scaling tariffs because supply chain issues. If you put a huge tariff on day one, you're going to have a lot of supply chain issues, and then you will have an inflation problem too. So, but I don't know. I think people are just way too complacent on the dollar. Like, if you get the tariffs on day one or in the first couple of weeks, I think the dollar's going to go up a lot. And I think part of the reason is that people don't like the levels, like dollars already rallied. So they're like, I don't want to be long dollars here. It's the end of the year. I had a good year. I don't want to give it back. Or I had a bad year and I don't want to lose more. So I think people are kind of risk averse and complacent at the same time. And like there's a decent cohort of people that think Trump's bluffing, but I don't know. That just seems like no way.
I would encourage you to listen, anyone listening, if you're in that camp, maybe have a listen to the interview I did with Juliette de Klerk. Nobody knows what's going to happen, but I think that a lot of people, you'd be unwise, Brent, to not look at the probability, right? Like, what if he means everything he says, or what if this?
Mm.
Like, you've got to look at all the probabilities. I know you have a course, Spectra school on your site, and I feel like this is when like uh, understanding how trading works, having a framework. We're going into a period of a lot of uncertainty, right? Like you've got to have a plan going into that. I would think it's going to be. It's from everyone I've talked to. It sounds like it's going to be really difficult sledding. Like there are no easy answers because there's so much uncertainty.
And I think like one thing that I try to preach in the course, thanks for mentioning that, is to think in terms of probabilities and not like in a deterministic way. So, I mean, I think the dollar's going up, but I'll always have like a tree of the possible what's going to happen, and then you can try to extract some expected value from that, especially if you use options. And if you have a situation like now, it's really interesting for options because if you think, okay, the dollar's not going to be here, it's either going to be 3% lower or 5% higher in the next 3 months. You can almost do both sides and still make money. And generally, I think people tend to be too deterministic, and the reason that's bad is that it just gets you into a mode of thinking like with confirmation bias where you're so confident in your view that you listen to all the people that agree with you, but then when people disagree, you're like, that person's an idiot. But what you actually want to do is like take the information that that person who disagrees with you said, and if you can rebut every point that they made, like that's great. And but otherwise, maybe you go, you know what? They kind of have a point on that one thing. I better at least watch out for that. Like
Right.
it doesn't mean you listen to someone and then keep changing your view because other people disagree, but you listen to other people's views who disagree, and then that gives you a framework to know when you're wrong possibly earlier because it gives you the signposts of like, yeah, if he hasn't done anything by January 31st, then maybe my view on tariffs is wrong because he brought in all these hawks and said he was going to do it on day one. So January 31st, I better reassess. So that's kind of how I would think about it, about things is, yeah, I think the dollar's going up, but I'm ready for scenarios where it doesn't.
Yeah, your point about sort of making sure that you don't go into an echo chamber is so important. And this is where, X and you can easily do that. And even if something like you said sounds sort of out of the box, like Juliet was talking about, for instance, because I've been thinking about this a lot when we're talking about tariffs. Talking about Elon and the impact of Elon, she had a very different perspective, and I was kind of like, well, the way the U.S. government works, but I really found myself like, okay, wait, what if this is seems like unusual to me, but what if it was right? Like, what if that
Mhm.
was possible? And I think it's really, really important. It's going to be really important to kind of try to keep an open mind in all of this. I'm laughing because, as is often the case in our chat, certainly on Fridays, people are sharing their drink of choice that they're entering the weekend with. And I got to tell you, Christopher, I haven't heard about a vodka Collins in a long time, but I'm a fan.
Wow,
I'm
that's
a
old
fan of
school, yeah.
That's old school.
It's like a
I love it. Bring
screwdriver.
it back, Christopher. We always threaten to have a real in life happy hour. We will do that, people, but maybe we'll have a virtual one first. I was going to try to swing it by the end of the year, but I got so much going on. I don't know if I'm going to make it, but we will set one up. We might need one by the time January's over, based on what we're hearing. All right, I'm going to extend it a couple minutes. We've got a couple of really, really good questions. Um, let's see. It- uh, I saw one from Harry, and I haven't seen Harry ask a question in a while. Let me get it, Harry. What's Brent's thought on JPY? Maybe continued strength into next year. I mean, we are remiss that we've gone a half an hour and not talked about the Bank of Japan and the yen. What do you see, especially with Brent of all people?
Yeah, the problem with the Bank of Japan is that it's relative to what's going on in the US, it's just always like the smaller thing in terms of levers, right? Like the Fed and US rates are going like this, and Japan's going like up and down like this. So I find generally the Bank of Japan ends up being important, around the events and all that, but bigger picture, obviously they've hiked a few times and dollar yen's high is still higher. I mean, the surprise hike that they did, I think in December 22, dollar yen was at 136 and now we're at 155. But to answer the question, I think that generally I'm bullish dollar, but I actually think dollar yen is probably like one of the worst dollars to be long right now. Partly because I do think the BOJ is normalizing enough to trigger some repatriation. So, the Japan has the biggest pool of savings in the world, and a lot of it's run by GPIF and Campo and like the big pension funds in Japan that hold all the savings and all the money. There's just like a small group of them. And they've been starting to talk about moving money out of foreign bonds into JGBs. So generally, like if JGB yields are zero, they don't want to be holding money in those because that's bad, obviously. So they would have money in the US or in Europe or whatever. But then if you now have European yields heading down to back towards 1.6 is kind of where ECB rates are headed. And then you have JGBs at like 1%. There's been a pretty big move, not as much in the US because US yields are still high, but like Canada, Europe, and other places have cut substantially, or SMB has cut as well. So I think we are at the front edge of some repatriation where the big money in Japan will start buying JGBs and getting out of foreign bonds. And so that will support the yen. Also, there's kind of now a limit because weaker yen is inflationary. It's politically unpalatable. The MOF has intervened already a couple of times. So there's kind of now this limit on the yen where selling yen, you have a kind of limited amount of money that you can make before the policymakers will react. But buying yen, there's a lot of upside. But since I'm bullish dollar, I want to being long yen and trading it against other currencies that I don't like Canada.
Yeah.
So like short
By
CAD
the way,
yen.
Brent has great stuff in his newsletter on Canada. Like that whole deep dive on Canada and the trouble that could be brewing there was fantastic. I want to get to this other question though. So I just encourage you to go to that newsletter and read that to get a little bit more on that, or you can
So just
contact.
let me tell people it's spectramarkets.com if you want to see my stuff.
Aw aw
SPECTRA.
Yeah, awesome. We'll drop it in the description as well.
Thanks.
Um, T. Fred, I wanted to flag this question because I think it's such an important one. And I'm gonna tell you right at the start, there's not an answer we can give, but Brent, I think that again, like I know you care about education so much, and so I thought this was a good one to flag because we're gonna get it all the time. It's what everyone's asking themselves. With a potential stock market drop, should the stock bond investment portfolio be rebalanced to the conservative side? Like, I have 2 questions I wanna add to that. We've seen this before. Things aren't moving in the way they were. Could we see stocks and bonds both go down? Which is a real worry to people who kind of think of this in the 60/40, whatever division that you could get it, as we were all kind of taught at one point.
Yeah.
And how do we need to think about diversification? Because I think that's what he's asking, right? If stocks are gonna go down, or she, sorry to
Mhm.
make an assumption. If stocks are gonna go down, how can I protect myself in terms of balancing my portfolio? How do we need to think about this now, Brent?
Right. So in 2022, you saw one of the worst periods for like the 60/40 or risk parity. And that's because inflation was high. So stocks and bonds were correlated and they went down at the same time and then back up a little bit at the same time. And that's the worst case scenario for like a diversified portfolio. And I actually think there is some inflation risk. The problem with answering this question is I'll just give my own example, and I think that might help, is that it depends on your time horizon because so like my son is going to school in a year and a bit, going to university, and I have money in his education plan. So that to me is a no-brainer to reduce equities and put money, but I put money into shorter term things like into 1 year and like T-bills and things like that because I don't wanna draw down 1 year before I'm about to take the money out, because the whole reason that stocks work in the long run is you have to sit through the drawdowns, right? So, as your time horizon compresses, to me, you should be getting more conservative because you won't have the opportunity to ride the drawdown. So if stocks drop 20%, then you gotta liquidate to pay for the kid's university. That sucks. So, in that way, I think it's a good time to get out of stocks and or reduce stocks and go into cash. um, I don't love bonds because of the that I'm a little bit concerned that they're gonna let inflation just kind of run a little bit before, like, the probability of a Fed hike is so low that, you could have inflation going up in a fairly meaningful way before the Fed's gonna react. I mean, similar to 21, right? They just wait forever because they really don't wanna hike, but they love to cut. So, to me, bonds are not like a great diversifier. I mean, cash is the ultimate diversifier, and you're still making 4%. So I'm more into reducing, like, the stuff that I've been reducing, is I'm just putting it in cash. I'm not putting it in bonds, because you're not really, I don't know, to me, you're not getting a safe haven by buying bonds if you believe that inflation, like, I don't think inflation's going back to 9, but if it goes back to 3.6, your bonds are not gonna be happy.
Yeah. So again, T. Fred, such a really smart question. You only you can know the answer. You know your risk profile. That's why it's impossible for anyone to answer that. But Brett, I think you did a great job using your example and think about time horizon and think about duration when you're talking about bonds too, not just bonds or long bonds. Like what duration bond and maybe cash as the safest. But if you don't have that as an option, these are the questions you can ask somebody, especially if you have a financial advisor, but there's a really smart one to start asking and not just assume everything's gonna continue the way it is. So I'm super happy that you asked that. Thank you so much. All right, we have so much more we could talk about, but we gotta go because it's Friday and people need to get started on the weekend, including Brent, who was nice enough to join us. Brent, I always love catching up with you, especially at the end of the week. Thank you so much.
All right, thank you, Maggie. Thanks everyone for listening and watching, and, have a good weekend.
Yeah, have a great weekend, everybody. Enjoy. Thanks for the fantastic questions. We'll see you again on Monday. Take care and good luck out there, everybody.